So you've packed your bags, you've said your goodbyes to the gray skies, friends, families, the constant rain, 40%, 45, 60% tax. You've bought your one-way ticket. But here is the million-pound question. Have you actually escaped HMRC? Because according to the latest data, 479,000 people immigrated from the UK between June 2023 to June 2024. But here is what most of them did not realize. The HMRC can still reach into your account, your pocket, for up to 10 years, even after you've left the UK. So even if you're sipping cocktails in Dubai or you're living your best life in Portugal, in this video, I'm going to be revealing the 7 critical tax traps that catch people when they're leaving or they've left the UK. So stick with me, because trap number 5 especially is the one that surprises a lot of people. And trap number 4, it could cost you and your family hundreds of thousands of pounds. Let's dive in. Now, most people think that leaving the UK is very simple. Pack your bags, cancel your Netflix, and you're done. But that cannot be further from the truth. If you don't file Form P85 or complete the SA 109 residence section, HMRC can assume that you're still a UK resident. And that means that they assume that you owe tax on worldwide income. Letters will start going to your old address, penalties will pile up quietly, and if you ignore them long enough, they could even go as much as enforcing and follow you even internationally to try and recover the debts. And all of this can be completely avoidable. So here's what you need to do to avoid this problem. If you don't normally file a self-assessment tax return, complete the Form P85. It's called Leaving the UK, Getting Your Tax Right Form, and I'll link it in the description. So you can file it online or by post. You'll need Part 2 and Part 3 of your P45 from your last employer. But if you do file the self-assessment, keep the P85 form, but you must need Form SA 109, the residence section, and you send it by post to HMRC. You cannot do that one online. Now, the next thing you need to do is to update your address immediately. Lastly, also you keep copies of everything, and whatever you do, don't assume that silence means compliance. HMRC doesn't work that way. But filing your P85 correctly is just the start, because even if HMRC knows that you've left, there is a 5-year tax trap that catches people who come back to the UK too soon. Now, picture this. You leave the UK in 2025, for example. You become non-resident. You've done all the paperwork. You're finally outside the UK tax trap. So you sell your shares. Maybe you have a £50,000 gain, tax-free, right? You're not a UK resident anymore. Then in 2028, you move back to the UK, maybe for family reasons. Maybe the dream that you were expecting in the new country didn't work out as planned. It doesn't matter. HMRC will treat that £50,000 gain as if it happened in 2028, the year that you just returned. Fully taxable, welcome home. And that's the temporary non-residence rule. And I can tell you, it's very, very brutal. Here's how it works. If you're a UK resident for 4 out of the last 7 years before leaving, and you return within 5 full tax years, any gains on assets before leaving the UK are taxed when you return. We are talking about shares, investments, certain business assets, everything. The HMRC basically rewinds your financial life and pull those gains back into your current year. That is the year that you return, if it's within 5 years. And here's the nasty part. You might have already paid tax on those gains in the new country, and now HMRC wants their own cuts. You may get some relief for the foreign tax that you paid, but it's usually messy, complicated, and expensive. The solution: plan to be a non-resident for at least 5 full tax years. Count carefully, be absolutely sure. And if you're selling assets, time it right. And if you need to return early, make sure you get advice before coming back to the UK. There might be ways to structure things, but once you're back, it's too late. One more thing: assets that you buy after leaving the UK are generally excluded. It's the ones that you held before you left the UK. Those are the ones that causes problem. Now, that trap affects investments and shares. But what about your UK property? That's where trap number 3 gets really, really expensive. This trap catches property owners almost all the time. Sell a UK residential property while you're abroad and you have 60 days. That's it. 60 days to report the sale to HMRC. 60 days to also pay the capital gains tax on that property. If you miss that deadline, oh dear, automatic penalties start applying interest charges on those penalties, and they start accumulating immediately. And this catches so many people all the time, because if you're a UK resident, you report capital gains on your annual self-assessment. You've got months to do this. But sell a UK property as a non-resident, those are different rules. You've only got 60 days from the day of completion to report and also pay up any tax that you might owe. But here's the kicker: even if there are no tax due, you still have to report it. It covers not just home, but shares in companies that also own UK property. And here's how to handle this properly. Before you even list your property for sale, set up your HMRC online account for UK property reporting. Don't wait until after completion. Then you calculate your tax liability in advance. You can't defer it. You can't spread it out. 60 days means 60 days. Set reminders, multiple reminders in fact, because missing this deadline is very, very expensive. And HMRC shows no mercy. Speaking of showing no mercy, let me tell you about inheritance tax traps that's catching everyone by surprise. So from April 2025 this year, HMRC set new rules that means that they can tax your worldwide estates at 40% for up to 10 years after you've left the UK. Yes, even if you've become a tax resident somewhere else. This is the 10-year inheritance tax bill, and it's the most aggressive change in the April 2025 tax changes. And here's exactly how it works. According to this new rule, if you've been a UK resident for at least 10 of the last 20 years, you're classed as a long-term resident. Now, that term is very important because that status follows you like a shadow. That gives the HMRC a tax tail, a period where your estate remains inside the UK inheritance tax. The longer you've lived in the UK, the longer that tail becomes, up to 10 years. You can see the breakdown on the screen, right, showing you based on how long you've lived in the UK, how long you're a resident in the UK, to how much the HMRC has in terms of tax tail. So imagine this: you've spent 20 years working in the NHS. You move to Spain, live happily for 8 more years, and then you die. Now, this is still within the 10-year tail for someone who was a resident in the UK for 20 years. And as a result of that, HMRC can still charge 40% inheritance tax on your global assets. That includes your property abroad, your investments, your business, shares, everything, 40% tax. Plus, whatever tax applies even in the new country of residence, right? Because they would also get their own tax. So what can you do? First, you need to check your UK residence history. Check that now. That's very important. Count the years carefully. If you are approaching 10 years, but you're not there yet, consider leaving sooner if that's your plan. If you have already passed 10 years, understand your tail length and plan accordingly. Consider life insurance, if possible, to cover the potential inheritance tax bill that might happen. Review your will and your estate. Do serious estate planning, because simply moving abroad doesn't break the UK inheritance tax connection anymore. That's a thing of the past. And here is something that catches people out. Trust doesn't also automatically protect you and your assets either. Of course, there are caveats, and this is where a specialist advice earns their fee 100%. So if you're in this scenario, please also get specialist advice on this matter. They would help a lot more. This is not DIY territory anymore. So please do that. Now, inheritance tax is the big scary one, but there are smaller traps that bite just as hard, like losing money you didn't even know you would lose. And that's trap 5. So quick question. What is the UK personal allowance for 2025-2026? 12,570. That's the amount you can earn tax-free. Now, leave the UK and become a non-resident. What's your personal allowance when you do that? 0. All of that allowance is gone. Every pound of UK income you earn going forward is taxed from the very first penny. That's something you also need to know. So let's say, for example, you have a UK rental income. You're going to tax it from £1. Let's say you have a pension. It's going to be taxed. This hits retirees particularly hard because they have a plan in their head without actually doing the research. And this is where they are caught up, especially things like UK property, UK rental income, doing that for profit. Suddenly, you're paying way more tax than you expected because you planned on a certain level of income living abroad. Just imagine someone that thinks that, oh, I would have like 2 rental property. Yes, it's not enough for me to live well in the UK, but I can move to Portugal, which is very popular now. And with that, I'll be able to live a lot more comfortable life because it's cheaper. Not factoring in the fact that they're going to be paying way more taxes compared to if they have withdrawn that money or they've taken that rental income living in the UK. So that's something that catches a lot of people. So what's the solution? Check if you qualify for the personal allowance under a double taxation treaty. That's the first thing, depending on the country that you're going to, because some countries' treaties would actually protect that, but some won't. EEA nationals and Swiss residents have certain protections, if I'm not mistaken. But don't assume. Check your specific situation. Do your own research and plan your UK income sources accordingly. In fact, I would say plan it as if you're going to be taxed from the first penny. So that way, even if you get anything from the treaty, it's going to serve as a bonus and not something that you're banking on. And as you know, these things change. If it's for something like retirement and it's way into the future, you could get to that time and things would have changed drastically. Sometimes it actually makes sense to restructure. Sometimes you just have to accept that higher tax, but at least know that it's coming. Now, let's talk about the trap that affects millions of people, because if you've got a UK pension, you need to hear this one. Now, if you were an employee in the UK, there are chances that you have a pension pot or multiple pension pots. For most people, the pension is one of the, if not their biggest assets. But the moment you move abroad, it becomes a minefield. In this tax trap, there are 4 mini traps that I'm going to be talking about just inside this one. The first one is transferring your pension pot to a non-qualifying recognized overseas pension scheme, or QROPS. Now, this QROPS is an HMRC approved list of foreign pension schemes. So if you transfer to one of these, all is fine, no worries. But if you transfer to anyone else, then you're hit with a 55% unauthorized payment charge. The second mini trap within the pensions is even if you're transferring to a proper Q-rope, you can still trigger 25% overseas transfer charge unless you meet specific conditions. And from October 2024, the exemption the EEA had was removed. Now, the third trap, the overseas transfer allowance is £1 million for 2025-2026. And if you transfer more than that, you're hit with the 25% tax on the excess. So let's say you have 1.5 million in a pension pot. That extra 426,000 gets hit with a 25% charge, which is going to be about 100,000 in tax. Now, this is just for moving your pension. Now, the fourth trap, you can keep your UK pension and just withdraw from it while abroad. Smart, right? Avoid all those transfer charges. But here's the thing. Your UK pension income might be taxed in the UK, even as a non-resident. And it might also be taxed in your new country. That's where it gets really, really unfair. You need to now claim double tax relief, which means understanding the double taxation treaty with the country that you're now living in and fill in specific forms to be able to get back that relief, right? Depending on the country that you travel to. Government pensions also have different rules than private pension, and some countries don't even have this treaty in place. So you just need to research and find out what is applicable to you as a person. So what's the solution here? Don't rush to transfer your pension overseas. That is as clear as day from everything. Seriously. Do your research or get a specialist advice first before even doing this. Understand the Q-ropes rules properly. Calculate whether the transfer charge makes that transfer actually worth it. Check for double taxation agreements. For many people, actually keeping your UK pension and drawing it into a UK bank account is going to be the simplest decision. You can then transfer that money from your UK bank account to your overseas bank account as needed. Yes, you're going to pay some UK tax, but that is the simplest way for a lot of people. But you also avoid the transfer charges and also the hassle of doing all the transfers. Sometimes simpler is better. Now, there is one more trap, and this one is about timing. Now, most people assume this. I leave the UK on September 1st, 2025. That means I am a non-resident from September 1st, 2025. Very simple, right? Wrong. The UK tax year runs from April 6th to April 5th of the next year. So that means that if you leave in September, you might stay a UK resident until the following April 5th, unless you qualify for something called the split year treatment. The split year treatment is actually brilliant when you get it. It literally splits the tax year for you into two. One part as a UK resident and the second part as a non-resident. You're only taxed as a UK resident during the UK part, but it's not automatic. You have to meet specific conditions, and there are different cases, different criteria that you have to meet in order to qualify for the split year. For example, leaving to work abroad has one criteria. Leaving to accompany a partner working abroad has a different criteria that you have to meet. Just retiring abroad, that's a different criteria again, right? So depending on your situation, there are different criteria that you have to meet. So what's the solution? First, understand the statutory residence test before you leave. I'll link that in the description also. Fill that out and know where you stand. Document your departure, date of leaving, reason for leaving, days spent in the UK before and after. All of that, document it. Employment contracts, accommodation, the details. Document all of that. Keep it all. If you're uncertain whether you qualify for split year treatment, you can ask HMRC for a determination. Get it in writing and don't guess. because getting this wrong is very, very expensive. Okay, now you know all the 7 traps, and if you're planning to leave, I have a totally free exit checklist down in the description. It has everything I've spoken about with all the links. Please go there and download it. I walk you step by step what you need to take, forms you need to fill, dates you need to remember, questions you need to ask your advisors if you've got one, right, in these scenarios, right? Everything, and it's completely free. Grab it in the description below. But remember, if you're in doubt after watching this video, after going through that checklist, please do your own research, speak to a professional, and as you know, these rules change from time to time. And tell me in the comments, what is your biggest question about UK tax after you leave? Also, don't forget to also like and subscribe for more videos like this. See you in the next one.